You check your portfolio, and one stock is down almost 40% in a single day. No bankruptcy, no fraud headline, no earnings miss. So why did EOS Energy just get absolutely crushed? Because this wasn't a normal dip. This was panic. This was forced selling. And this is exactly the kind of move that can either create a dead cat bounce or signal something much worse. Let's break it down fast. First, today's market was a bloodbath. The S&P dropped, the SDAC dropped, risky small caps got destroyed, and EOS sits in the highest risk category, cash-burning, debt-dependent, story-driven. When the market goes risk-off, these names don't fall 10%. They fall 30, 40, 50. That's step one. But here's the real problem. The volume today was massive. We're talking tens of millions of shares. That's not normal selling. That's panic liquidation, funds cutting exposure, retail hitting stop losses, algos accelerating the move, price drops, fear spikes, more selling, price drops again. That's how you get a straight line down. Now pay attention to this. EOS has a balance sheet problem. They are losing money on operations. They have negative interest coverage. That means they don't generate enough profit to even cover the interest on their debt. That is a huge red flag. For growth companies, losses are normal. But when losses meet debt, that's when survival risk enters the chat. And Wall Street started pricing that in. This surprised Wall Street. Analysts recently warned that EOS could violate debt covenants. In simple terms, that means lenders can say, you don't meet the rules, you don't get the money. And for a company that depends on outside funding to operate, losing access to capital is like losing oxygen. No funding, no runway. And the market hates that scenario. But it gets worse. Late last year, the company announced plans to raise hundreds of millions of dollars through convertible notes and new stock. That helps the company, but it hurts shareholders. More shares means your ownership gets diluted. So smart money sells before the dilution hits. That selling pressure builds quietly, and then one bad market day triggers the avalanche. That's what today looked like. Let's talk psychology. EOS was a story stock. Energy storage, next-gen batteries, huge future potential. Retail loves that. But when a story stock starts showing negative profits, debt risk, dilution, and analyst downgrades, the narrative flips from growth to survival. And once investors start questioning survival, valuations don't matter anymore. Here's what could happen next. Scenario 1, short-term bounce. After a 40% crash, shorts take profits, dip buyers step in, and the stock pops 10 to 20%. That's a trade, not a recovery. Scenario 2, the slow bleed. If cash burn continues and more dilution comes, the stock could grind lower for months. No big crash, just lower highs and lower lows. That's the most common outcome for distressed small caps. Scenario 3, high-risk turnaround. If EOS secures funding, stabilizes debt, and shows real revenue growth, this becomes a speculative comeback play. But understand, that's venture-level risk in a public stock. High reward, very high risk. So what's the lesson for retail investors? Balance sheets matter more than hype. Dilution is a silent stock killer. And in market sell-offs, weak companies fall the hardest. EOS didn't just drop because of the market, it dropped because the market exposed its weakest points. Now the big question, is this an overreaction that creates a bounce opportunity or the beginning of a long downtrend? Because if funding risk becomes real, this stock doesn't just dip, it reprices entirely. But if they secure capital, volatility traders could have huge opportunities. So I want to know your move. Are you buying this crash for a bounce or staying away from cash-burning small caps? Comment bull or bear on EOS and drop your price target. Subscribe for more fast breakdowns of the biggest stock moves before Wall Street catches up.